Hello, everyone. I hope you're having a wonderful day. I hope you're ready. I'm ready. It's time for your market update. All right, we're going to go ahead and I'm going to share my screen and we're going to jump right into it. All right, so my last video kind of walked you through some great resources for you to utilize, educate yourself on the current market, what's going on, so you can come up with your own determination, again, to educate yourself, but also educate your consumers and become an advisor and not a salesperson who's just spewing information. Let's be honest, a lot of that is happening right now. So we start here, fear and greed index. Since my last video that I did, what emotion is driving the market right now? Fear. So we were in extreme fear though. So this is actually an improvement. So let's get market momentum. Essentially, we want to see this go up and this go down. I'm sorry, we want to see this go up. We do not want to see it go down because this was bad. This actually has a relative direct relation to what we've seen with mortgage rates. It's roughly the same patterns, roughly the same thing that we're seeing on all of the mortgage charts or mortgage rate charts for the coupons and also the US Treasury bond. So when we see this actually, again, with that direct indication, again, we are seeing some pullback here with mortgage rates as well. That has helped rates decrease a little bit. But again, we're in extreme fear. There is not a ton of market momentum. We have a little bounce off. I do think this is a temporary bounce off. This looks more like a bear flag. I can't really draw it on here, but this would indicate potentially that we are going to reverse after we see a nice little bounce, potentially up to this 125-day moving average. And in my opinion, I do feel like we are due for a massive dump in our economy. So whether we see just a nice dump right here at some point in time coming up in the next quarter, next 3-4 months, or we see a dump, like a one-day dump, or we see a dump and then we see a long recovery period. It just depends on what actually transpires. If it's going to be slow, it's going to be quick, but we are very prepped for something to take place. But if something does happen, that's good news for us, because then that's going to take away a lot of the uncertainty of what's going on. When you have just a massive dump, that means we have gone a direction, we have decided a direction, and we have went to the bottom. And once you go to the bottom, there's nowhere to go. So you go to wherever that bottom point is. Roughly, you're going to be right around, again, whatever that bottom may be. We'll hit that peak. We shouldn't really go much further than that. And then again, maybe we see a quick recovery, or we see a longer recovery, but that will make investors more confident than on the direction. You have to give them a little bit of time, but they will feel more confident on what the future holds, and look to improving a lot of what they do on the mortgage side as far as interest rates as well. So we'll go over here to stock price strength. 52-week highs versus 52-week lows. Are there more highs than lows based on where we are today from last year? Right now, we're in extreme greed because things are looking good, but you can see this nice little turn. So that may indicate that, can we stretch it up here, or are we gonna kind of turn the corner and go back down? Just really depends. If we look at breadth, so looks at the volume, amount, shares that are rising compared to the shares on the New York Stock Exchange that are falling. Things are just falling. So that's extreme fear. So essentially, no one's actively buying. Everyone's just dumping what they have. So if we had to look at it, investors are saying, I want to pull my money out of the market because I do not want to lose any more money. In fact, I feel like the market's going to get worse. And so that's the idea behind the extreme fear. And so before they want to put in their money, they want to have things just stabilize. So the key is stability. Once you have stability, people are confident in a direction. And so being that we're in a bearish market, or things are getting worse, I fully believe that we're in a recession along with many others. There is political agenda behind not releasing that we are in a recession. In fact, the government just redefined what recession means, or they redefined recession itself to basically state that we're not in one. Again, which is why political agenda goes into that, which is absolutely ridiculous. And it gets kind of funny what our government does. But if you can see here again, just everyone's selling. So once we have that stability, we will be in a value zone. So that means that investors are going to then pour in their money, because once things take a turn after the bottom, they are going to make a crap ton of money. So that's a very key thing. But that direction then indicates we're going to have stability in the market, which means mortgage products are going to roll out even more, and they will want to lower interest rates to be able, because they will be able to make more money in the market. And also, when you're going to lower those interest rates, prices will then start to decrease. We should see a decrease in price. So where you made $2,000 on X loan, now that $2,000 gets you a lot further as prices decrease, so you can lower the interest rate. Okay. So again, just an example, if an investor was making $2,000 on said conventional loan, and prices start to decrease, they now can buy more with that $2,000. So once they've recouped their losses from this market, and we go into our next phase, or now a bull market, we'll call it, they will be able to say, okay, I can lower interest rates because my 2,000 takes me so much further at this point. Okay, so put and call options. So essentially, options or contracts give investors the right to buy or sell stocks, indexes, or other financial securities at an agreed upon price and date. So puts are the option to sell, and calls are the option to buy. Okay, so when the ratio of puts to calls is rising, so it's going up, it's usually a sign investors are growing more nervous. So we see this going back up. We do see a little break off right there. Again, does that mean we're going to come down, or does that mean we're going to go up? Look over here, there's a break off. Here's a little bit of a break off. Generally, we have gone down, but we will typically then bounce right back up. So question is, are we going to bounce, go down, and then spike up? That's probably the indication. What you want to look is more at a longer period of time. So over here, we see this kind of trend going, versus if I can't actually go back, but you see this probably was a downtrend, and then now we're going back up. So I would expect that we're probably moving into extreme fear at this point. So investors would be nervous. So nervous is bad for interest rates. Okay. Market volatility. So most well-known measure of the market sentiment is the Cboe Volatility Index, or VIX. The VIX measures expected price fluctuations or volatility in the S&P 500. S&P 500 is measuring 500 large companies that are on the US stock exchange. So the S&P index options over the next 30 days. Okay. So the VIX often drops on days when the broader market rallies, and soars when the stocks plunge. So when things rally, okay, so the broader market rallies, you're going to see a drop and it soars when stocks plunge. So right now the market is rallying, but are we going to continue to rally, or are we going to pause and take a turn? So if you kind of look here, you just kind of gauge based on these indications. Right now we're on a pattern going in this direction. So since we're going this way, this would put us into a fear mode. Once we go over here, go over this 50-day moving average. We'll see here, we go down for a little period of time, and then we shoot back up. Little period of time, shoot back up. Little period, shoot back up. So this is a kind of a constant thing. This has been happening. This is a little bit longer of a descent, but that could indicate this is just building up pressure for us to go down and then spike back up, because these are all spikes. These are major shifts right here. You can see here, this was like January 14th. It kept going up all the way until January 25th. So just major spikes that just massively pumped in this period of time. Okay, so I would say we're probably gonna hit a new low and then bounce back up. But again, we should still kind of see this trajectory. I would imagine, again, you see this kind of coming down, probably was kind of coming in this direction, and now we're going in that direction. And then safe haven demand, stocks are riskier than bonds. So the reward for investing in stocks over the long haul is greater, but still bonds can outperform stocks over short periods. So if you look over here, stocks outperforming bonds, bonds outperforming stocks. So bonds, stocks, bonds, stocks. So if you look over here, go back, bonds do better when investors are scared. So investors are scared, not scared, scared, confident, scared, a little more confidence, but back to scared. So right now we're in this fear mode because investors are essentially scared. So again, our stock's going to kind of bounce up. This is kind of showing a new low. It's kind of stayed stable, maybe a new low at this point. But here we got a new low. So new low, maybe a new low at that point, a little bit lower, a new low. So it almost indicates that we're seeing again this little revival pattern, probably going to hit a new low, maybe spike up, go back down. That would be my indication. But again, come up with your own theory or idea on what you feel. But it just depends. So I would say we're probably going to we're due for a dump for a new low. But again, it really just kind of depends. Junk bond ban. So junk bonds carry a higher risk of default compared to other bonds. Bond yields or the return you get on investing in a bond dip when the price goes up. Okay, so if investors crave junk bonds, the yields drop. Likewise, yields rise when people are selling. So yields rise and people are selling. So selling, buying, selling. So people are just selling off everything. We see a little bit of pullback. So we see a little bit of buy power here. Again, are we going to kind of bounce off and go back up? That's probably the indication because that's the way the trend is. This is a nice building pattern because it's got a nice little U. This isn't like, hey, we're doing a little flag here and then pumping back. This is just a standard curve. For us to go over would be pretty tough, especially with the indications of what everything is going on over here. So again, it would be good for us to see this market volatility, market volatility kind of bounce and then put us into extreme fear and just let the market take a dump so that we can have confidence in the fact that we know kind of the direction now, or we have made a decision on what's happening with the market so that investors can become confident in where they want to put their money. Again, that would put them in a value zone where they're going to make a lot of money. And then from that point on, ideally prices should decrease. So as prices decrease, again, if $2,000 for said conventional loan, at 5.5% got you X things, that was your budget. And then prices start to decrease, you now can buy more with that $2,000 because your prices that you were for your budget, like whatever, the expenses were, have also decreased. So you have a lot of room for profit. Hence, they will lower the interest rates to consumers. You can't do anything about past loans, only future loans. Okay. So there's our first spot. The next one, we're going to go to the U.S. Bureau of Labor Statistics. Again, the one I kind of released or I went over before with you as far as the second resource. So I do have a lot of these numbers kind of already put together. So the consumer price index, we'll be able to see again, you can kind of look at these on the right side. You'll see it was a 1.3% increase, but we did see a 1% gain on prices in food. So we also saw an increase there, 10.4% on energy commodities for gas, fuel, but we did actually see a drop of 1.2% for fuel. So that's actually good, at least for us for right now, especially with what's going on over still in Ukraine and Russia. So the fact that that is going down, you saw gas prices kind of drop over the past week. That's been a good sign. And so we move over here to energy services, electricity, utility, 3.5% increase on prices, commodities, less food and energy commodities. So we're going to look at vehicles, apparel, medical care. That at an increase of 0.8%. Shelter, transportation, medical care at an increase of 0.7. Shelter itself was 0.6, the majority of that 0.7. Now, just so you understand, the shelter service that a housing unit provides to its occupants is the relevant consumption item for the consumer price index. Okay, so it's not like, are you buying a home? Okay, so most of the cost of shelter for renter occupied housing is rent. For an owner occupied unit, most of the cost of shelter is the implicit rent that owner occupants would have to pay if they were renting their homes without furnishings or utilities. And owned housing units themselves are not priced into consumer price index housing surveys. Okay. So going to the unemployment rate, these are the same numbers as I released my last week, but again, we're at 3.6% from the last recording. And the one I do like to look at a little bit is the long-term unemployment rate. So 22.6% of this population of 3.6% is actually long-term unemployed. So that's a pretty good chunk that says, hey, we're just not employed. We're not actively looking. We're kind of just kicking back, whether you are, collecting a check from the government or who knows what, but you are unemployed. So again, it's a pretty massive as far as the long term, not actively seeking jobs. So again, pretty big portion of that. Now, again, payroll unemployment had gone up 372,000, which again, same in the last video. But as far as that is it's hard to determine if that's a good number or a bad number. Because the thing is, when you just create jobs, it doesn't mean you're actually fixing the problem. So you have said jobs, you have people that are unemployed. So we'll say it's 3.6%. Well, more of these jobs that have existed have increased their unemployment, whereas other jobs have just been created to band-aid the issue and just put them into jobs. So it's skewing the numbers of the 3.6%. Now, as time goes on, again, as I mentioned before in my last video, like there's certain jobs that are no longer in use or they're very minimally in use. So we'll use like coal mining. Coal mining is not as big anymore, especially in the United States. So those numbers for unemployment have dramatically increased over time. And then you have new jobs that come in, like a social media marketer or who knows what. So those are new jobs that are created. So whatever these new jobs kind of come in, they will come in over time. The question is, if you're just band-aiding the issue by are we just creating jobs just to create them, just to kind of skew the unemployment rate? Well, there is political agenda potentially in that. So again, it kind of gives us this position that unemployment may actually be larger than it really is. And with the government redefining what recession is, which is the fact that our government would even do that is just ludicrous. But to redefine recession just to say that we're not in a recession, again, alludes to the fact that we're probably skewing some numbers to avoid having to say we're in a recession, especially with elections coming up and things like that. So we have to really look at the numbers very, very carefully. I would not necessarily look at this unemployment rate as necessarily a good thing. The fact that it has stayed the same, that's probably more of a negative in my mindset. So maybe they're kind of just filling it, more of a political agenda thing right here, but it just kind of depends. And then obviously payroll and employment, again, 372,000 jobs. Okay, that was an increase. Now, we do look at average hourly earnings. They had increased by 10 cents per hour. And then the producer price index, we saw an increase of 2.4% in prices for goods and 0.4% increase for prices of services. The employment cost index, which showed a 1.4% increase as far as cost for employees. Productivity did see a drop of 7.3%. So essentially it would be as if, if you were working 40 hours, you are now, maybe not you directly, but as far as population goes, the productivity rate has gone down about 7.3%. So you're doing less with your 40 hours. US import had an increase in prices of 0.2% and export 0.7%. So now we look at just essentially job news. So this is, this news up here. So kind of broken down, we saw job gains. This was from Q4. So the fourth quarter of 2021. We did see 781 job gains and 785 job losses. So that with having 785 job losses, actually puts us in the negative at that point, which would indicate if these jobs are being created, that would have probably spiraled more if these new jobs were not created to fill the Band-Aid problem of maintaining a 3.6% unemployment rate. But again, I'm not the insider of that information. So I'm not the person that is, actually reaching out to these people and figuring out what the real nuts and bolts of it are. There are some, again, political agendas behind it, so it's hard to really dictate what is going on. But this is a good sign of saying, hey, from Q4, we saw more job losses. Now we're gonna go to construction. So just key thing with construction. So construction unemployment saw an increase of 2.3%. Construction unemployment compensation costs only increased 0.1%. So that's actually not a bad thing. I put that more as like a neutral. We had job gains of 219 and job losses of 189. So we did see more job gains in the construction field, which does indicate that things are a little bit better as far as construction goes. So that's good. So now we also see here, so on 7/22, June jobless rates were down in 10 states. So 10 states, basically the jobless rates went down. Again, kind of puts us in this unemployment category. What is exactly going on? It was up in 2. And then payroll jobs were up in 13 states and they were down in 2. So this, again, as far as jobs go, it's kind of a skewed, these are skewed numbers right now. So are they going to stop with this job creation and band-aiding the issue? And then once, elections happen, they're going to let it go into chaos? Or are things going to kind of take a turn and they're going to announce we're in a recession? It just depends on what they end up doing. May job openings rates down in 11 states and up in 3. So job openings it's good that, the rates went down and then they're up in 3. Quits rates were down in 7 and up in 2. So people are staying at their jobs and people are getting hired. Again, more on this job side, what's going on. Full-time wage and salary workers median weekly earnings are 1,041 per week in Q2 of 2022. And US import prices increased 0.2% in June on higher fuel prices. Export prices rise 0.7%. All right. So then we're going to go on down here we're going to go to our next category, which is MBS. So MBS, this one, unless you sign up yourself, it is for loan officers. I don't know if you can actually sign up, but I'm going to go ahead and go over the information with you. So we just go over here, just going over some key data points. So rate position, we do see here. So we have the 50-day moving average, and we have let's see here. So 50-day moving average. And then we have, where's the next one right here? So in the 100-day moving average. So right between the 50 and 100, whereas before we were between the 25 and the 50. So this is actually up. Where we are now is actually up from July 1st through July 21st. We were in this zone and now we are over here. So this is good. We're kind of maintaining right here, but this is starting to creep down to this level. So is this going to kind of push us down to where we're going to go back in this direction? It's kind of hard to tell. That is the indication though. We see let me back up a little bit. Let's go over 6 months. So we do see new low. So down, like lower. And then we go higher. So are we going to go higher again? Because if you have new high. Are we going to hit a new high and then bounce back up and then stay up there? Or are we going to go down? What's going to happen? So my indication, ideally, this would indicate more of a bear flag trend. But with this kind of pattern that we're seeing kind of this higher low, right in this ballpark. I would feel that we're going to get to a new higher low and we're going to bounce up. And then from there, it's hard to tell just based on the economic news if our economy is just going to take a dump, because if it would, we may see some increase in rates. So rates go up, rates go down. So we may see some increase in rate, but then see stability that will then kind of carry us over into the next bull market. But again, that would be good. I would like that because I want stability. You should want stability. But if we do go back up, it'd be great to see a bull market just start to take a run for it. And well, I should say, when rates initially go down, we're still in a bear market, but eventually that turns into a bull market and then things start to curve. So the idea, it would indicate initially that we're going to go this direction, but again, we may, with that dump, that may actually put us in a position where, again, if I was giving $2,000 for said loan, and cost of goods go through the roof and the economy tanks, they may just have to raise interest rates because that $2,000 doesn't fill their budget, and they have to increase rates to cover their budget. But housing also, you need, as far as real estate goes, it infuses a lot of money into our economy. So they may then kind of turn their hat and say, we need to infuse money into our economy. So let's drive down rates, take our losses, but let's try to do more loans so we can get more money back into the market to kind of let things stabilize, but let consumers pull out equity or do what they have to do with their homes to access them, because we need to come in and we need to assist and we need to help. So it just kind of depends on the decision of how investors react and how the mortgage market reacts to it. Again, it's not a direct relation of the S&P 500. It's not a direct relation of the inflation rate, but they do all interconnect. Okay. We did see app volume increase 1.8%. And we did see home purchase volume over the week. We saw app volume decrease 1.8% over the week. And then apps for home purchases also decreased 0.8%. Apps for home purchases year over year was down 18%. Refinances for the week were down 3.7%. Year over year, they're down 83%. So just as a great example, I was talking with someone yesterday, and in their particular situation, they got pre-approved by 4 people. Now, there was a lot of things going on with the credit from what I saw, and I wanted to make sure an underwriter reviewed that, because it was a situation where the underwriter has to make the ultimate decision on that loan. Okay. So certainly underwriters always make the decision, but let's say you had a standard W-2, 800 credit score, 720, whatever, perfectly fine credit, no issues. You just have their salary in there. You see they qualify. The underwriter, yeah, they make the decision, but they're not really like, the guideline works. But if there's certain instances where the guidelines say it's up to the underwriter to make the determination, not Fannie, Freddie, FHA, VA, or USDA, you need the underwriter to give you that decision up front. So that's why you send it to them first. But you want to make sure you gather the appropriate documents. Well, those were not requested from the client. So when I requested those documents, they were very turned off. They were very confused why I was asking for those things. I gave them all the reasoning behind it. They did not feel comfortable giving that information, or gathering the documentation I needed. But that just shows you that even though I'm doing things right, so many other people in this industry are doing things wrong. And that's a big problem with what is happening in our industry on the mortgage side. So when you see this number at 83% of refinances are down, 18% are down year over year for home purchases, these are massive decreases. So people are going to start coming out of the woodwork, and they're going to start doing whatever just to appease a client and get them in the process. And then once they're in the process, they're just going to figure out if they can make it work or not. And unfortunately, that puts them into a position where then you will have a handful of loans that are going to get denied, or even people that are going to lose their earnest money, their appraisal money, and even partner business. So from you, like if you're a realtor or a builder or whoever you may be, a lot of these originators will then start losing that business because then the process is going to go bad. They didn't do their due diligence up front. Okay. So we take a look here and we look at the coupon. The coupon is actually up about 22 basis points. So we would be able to see if this goes up, rates go down. So with this number being in the green right here, this is good. This is down, which is actually good for rates because the more it goes down, the lower the rates go. So US 10-year treasury bond, if that goes down, rates go down. Coupon goes up, rates go down. Okay. Ideally, and again, these coupons you see 5, 4, 3.5, 4, 4.5. You want to see the lower numbers. So right now we're pretty high at 4.5, but we want to get that back down into the 3s, potentially in the 2s, because that's when rates get nice and pretty. Now we go over here, and so we look at the S&P 500. The S&P 500 is up 54.09 currently. And then we look at pending. So now we're going to go over here to pending home. So pending home sales was actually increased 8.6%. So we have an 8.6% in pending home sale increases. I'm sorry, decrease. So we have a decrease of 8.6% month over month in pending home sales. So we do see that number starting to fall. So we're going to go here and go by the numbers. So here's just some good information. I do like to kind of point out a couple things. The next 2 months, August and September, have been 2 of the worst performing months for the S&P 500 over the last 30 years. So that's not good. That's an indication that between August and September, we might see quite a big dump in our economy, and we are prepped for one. So the idea is that right in this time frame, you might see new lows across the board. Again, how are rates going to react to that? Like, we don't know. It just depends. This is a little bit, with all the market volatility, rates could go up. They could go down too. It just depends on the standpoint of investors and what they decide to do. And then this one, zombies. So an estimated 1 out of every 6 companies, 17%, domiciled in industrialized economies worldwide have been able to stay in business throughout the pandemic, okay, and avoid bankruptcy. Great degree because low interest rate debt. That's key. Low interest rate debt. So 1 out of every 6 companies, industrialized economies, stay in business. They avoid bankruptcy with low interest rate debt. So these zombie companies, essentially the way they are in existence is they're not really profitable. And all the government does is the government just gives them money. They give them low interest rate debt and just say, hey, we're gonna kind of help you along because you have jobs. Or they'll say, here's a little bit of more money, go get some more jobs. So that's also another side to it. Are they filling these zombie companies that they're lending to, telling them to create some jobs to fill this unemployment rate with elections coming up? So that's just a big sign here that, again, they've kind of stayed in business. They've avoided bankruptcy, low interest rate debt. That could be another indication that, again, some of these numbers with unemployment are skewed. There's more in there, but essentially that's the bulk of what we're going to go over. All right, so the next thing we're going to do is we're going to go ahead and go over here. We're going to go look at the housing price index map. So if we look at the housing price index map, you're going to see wherever you're located, whether you're in Maryland, Indiana, Ohio, Florida, wherever it may be, you can kind of see, where your, change in housing price ends up. So here, like Indiana, where I am, 15.65, you can kind of see those lines. So Indiana, there we go. So as far as those price changes go, again, I mean, you're going to see a little bit of, decline. I would expect, over the next coming months, some more brown. So 20% below the national average, some more, probably a little less green. And again, certainly just a massive chunk of gray. So really not much of a change as far as that goes. But again, that's kind of what we're seeing here as far as house prices. stabilizing a little bit more from the dramatic increases that just took place. So again, just good nuts and good nuggets for you to take away. So now we're going to go ahead, jump on over here to the NAR. So if we go here, first one, existing home sales. Look here and you'll see we're down 5.4%. We go back, pending home sales. We are down 8.6%. And then we'll look at the home affordability index. So the key things to look here at the home affordability index, go to the monthly index. You'll be able to see a couple key things I'm looking for. 2019, 274. This is national average. Then it bumped up to 300. Then it bumped up to 357. So some pretty dramatic increases that we're seeing there. But if you do look here, you see 361, pretty stable all the way until about January. And then you do see a $10,000 increase. So you want to look at that as pressure's building up, and then it pops. And it just a nice pop right there. Just a really dramatic increase up to 414,000. So a nice $50,000 rough increase that we're seeing there. Rates did the same thing. Pressure, then pop. They go up 0.4, 0.3, 0.4, 0.8, and then back down to 0.2. So maybe we're getting to another pressure building phase. And hopefully that'll drive rates down for Q4 and Q1 of this year into next year. Monthly payments, obviously, the higher the amount and obviously the rate that goes with it. Generally, these payments are going up just because purchase prices have gone up. You do see some minimal changes, decrease depending on home price or the rate that was there. But payment as a percentage of income, so you'll see here 15, 14, 16, but 16, 17 stayed there and then pop. So again, because these rates increase, home prices increase. I mean, up to 24.4% is pretty high. And then you see median family income, you see 80, 84, 87, but again, generally the same, but from, May all the way to, May of this year, you saw, a nice $4,000 increase roughly as far as median family income. Now, qualifying income is interesting because you look over here, 50, 49, 57. I mean, okay, we saw 7,000, each across the board, but you go from 58 all the way to 88. So this is like, almost the same, where this isn't even close to being the same. So this tells me one income earner is pretty much qualifying for the home. So people are kind of keeping it in one person's name, and then you start to see this transition where this increases. So either, in the lending industry, we're finding, other ways or other forms of income for a single person, or we are finding that we are having more people co-sign at that point as well. Now, if you look at the breakdown here, Northeast 411, Midwest 298, South 383, and West 651. So again, that's a big reason the 651 mark at 2897 of just principal and interest indicates that, people would move out of the West. So that would be a reason for people to move to the Midwest or Northeast or South. Certainly the Northeast or South are very comparable as far as their home price. So you wouldn't see much of a transition there. But as far as Midwest goes, that's the reason why people move to the Midwest, because, these home prices are just so much less on average. So again, with these rates, just shows you 2897 versus 1325. Just that's a huge dramatic, decrease if someone were to move from the West to the Midwest. So you see here 17.8% versus 35.8. And I can just imagine in the West, if you add taxes, insurance, and even mortgage insurance into that equation, that's where you see a lot of people needing to utilize FHA, VA, and USDA loans. But the interesting thing is you see here 102.87, 89.63, 82.81 makes sense. But 97.139, that means we're probably getting a lot of not occupying co-borrowers to co-sign for loans in the West to get people to qualify and possibly do conventional loans or whatever it may be. So again, good information. This is all free to you. And then as far as last one we're to go to is the housing shortage tracker. So this one just indicates as far as housing shortage in your area. So I'm going to look at your area. You see not that much red in here. 2020, 2021, we saw a ton of red all over the place, but now we're in a lot of blue. So a lot of blue just says we have a lot of sufficient supply in most of the country. Certainly just look up your area. This is free. Go to NAR's website, but you can see here, again, we have quite a bit of blue. It's kind of lingering around. I would expect there to be more blue come up. Certainly no job creation. this color of the entire country. Job loss, there's a couple job loss areas right there, Shreveport and area of Oklahoma, some West Virginia, Kentucky, Toledo, Ohio, some places like that, Canton, Massillon, Akron. So you see some places there, but the permits, again, these have slowly gone down as far as permits goes. Certainly we'd see in Baltimore, we have, permits still backed up. But as you can, from COVID, these heavy metropolitan areas, for them to, just recoup and get back on track. And then at that point, be able to catch up and, get their feet or get themselves out from being underwater. It takes a minute. It takes years sometimes to do that. And so hopefully this is a nice recoup period for, some of these places to, get their permits, get more permits at that point. Again, not much housing shortage that you see. So again, generally look at your area. You see, here at Palm Beach. So Florida, California, Jersey, Pittsburgh being on that list. There's a big chunk here in Pittsburgh. Tuscaloosa, Alabama, to have a housing shortage is pretty interesting as well. So we're going to go ahead and go out of here. One thing I would just recommend is going here on the Realtor's Affordability Distribution Curve and Score, which measures the housing affordability at different income percentiles for all active inventory on the market. Shows how many houses are affordable to households ranked by income, while the score is the measure which is intended to represent affordability for all different income percentiles in single measure. So if we just look here, generally you're just looking at the score. So the higher the score, the better. So Ohio, it's more affordable. It's got a score of 1 versus some of these other states, which some of them are actually kind of surprising. If you actually look over here, Florida being at 0.49 or Tennessee being at 0.63. I wouldn't expect those states to be there. Maybe Florida, but definitely North Carolina, Tennessee, I'm kind of shocked about. Some of these other ones, clearly you can kind of see, hey, these are definitely affordable, and certainly Iowa kind of takes the whopping right there. All right. Now, I would definitely recommend if you go here, if we're on the NAR website, we go to research reports. If you look at the research reports, there's some good information here. Not commercial, consumer opinion, housing opportunities and market experience or home survey. Financing, just the impact of student loan debt, down payment expectations and hurdles to home ownership. Mortgage originators survey. Home buyers and sellers, again, just some great info for you to educate yourself, to become an advisor and really be able to pour into your consumers as an advisor versus just a salesperson. That's the whole goal, is to be an advisor, not a salesperson. So I'm gonna go ahead and just wrap this up as far as the market update goes. So generally what we're seeing here is we see, again, we're in fear right now. So that's driving the market, a lot of fear. No one knows really what's going to happen. It does look like we're ready for a big, massive dump. We're seeing a lot of these charts, including the interest rate charts, that do show we're in a little bit of a recovery period, but it does indicate that we're probably going to see a nice little dump. The question is, how's the mortgage, how are investors going to look at the mortgage, are going to look at the economy as a whole and respond to this? Are they going to drop rates? Are they going to increase them? Because certainly you would say your $2,000, if the market takes a dump, is not going to buy you, or is not going to fill your budget as it would, back in 2020 when prices were a lot cheaper. So certainly you would want to, recoup and increase rates, but also any sort of real estate infuses a lot of, any real estate purchase, refinance, things like that infuses a lot of money into the economy. So that could be, their effort to, hey, let's lower rates and just do more loans in order to stimulate the economy. So it just depends on how they're going to react, how the bond reacts, how everything kind of reacts overall. Again, we see a lot of market volatility. All just negative stuff. You see prices going up, the unemployment rate, and and the payroll employment indexes are very skewed at this point. I like going off of this, which shows that we actually in the fourth quarter of 2021 saw more job losses than job gains, which does indicate we probably were on that trend, and we're just creating jobs. There's a lot of zombie companies out there. So since there are, again, with all this news, it kind of seems more of a political agenda for them, for our government to kind of skew the idea of the fact that we're in a recession and they're not announcing it again for political gain. But again, we will see. The numbers are the numbers. You can't avoid it. You can only redo debt for so long for these zombie companies and things like that. There's a point when things have to just take their natural course. So if we go here again, I would indicate everything here indicates we're going to see some sort of bounce back from, or possibly like a little bit of a rate hike from where we're at now. But I would expect at some point in Q4, Q1 for rates to have their relief. As far as the market goes overall, again, I would say based on the real estate market, I would say we're probably going to see more of a dip with how things are increasing in price. So we're going to see more of a dip in home sales and pending home sales as well. Again, as far as rates go, it's just really hard to tell. But we have been stable through this period. I mean, again, we're still seeing market volatility, but we've kind of been trending on these lines. So are we going to go back up? Are we going to go down? How is it going to respond? With the S&P 500 having two of the worst months ever historically in August and September, I would anticipate that's probably the period. If we're going to see a dump, we probably will see it, whether it's August or September, but we shall see over the next market updates. One thing I will look here to incorporate is consumer debt. So being able to watch some of those trends as well, because we do see a lot of consumer debt. So again, a key thing is selling your home to pay off debt and buy a new home is actually a great thing to lower your overall expenses, and then you'll refinance when rates go back down and reduce them even more. Or obviously pulling out equity to some degree to be able to pay off your debt, because consumer debt has increased over this period of time. So a lot of good info. Now we're just going to go over some info that I'm going to be releasing as well. So for you guys, what I'm going to be doing is in my, actually, I'm going to do this on my YouTube channel and exclusively post it into the Telegram group so that you can go ahead and see it directly. But I'm going to be doing a lot of consumer education and also just education in general on the mortgage industry, from market updates and things like that, like this. But also I'm going to be feeding in content on painting the reality of what loan officers do. Because I feel the population, there's so much information, but we have to advise. And so in order to advise, there's a lot of misinformation out there, a lot of people just giving random bits of information. So I'm going to do things like, what does a loan officer really do? How are rates actually priced? And do some really cool videos so that consumers could be educated, but so can you. And then you'll be able to, at that point, take that information and start educating your consumers on the market and everything that's going on in the mortgage industry to help them navigate a little bit better on what to do. So hope you enjoyed this. I'm very excited to be releasing out, a lot of video content for you guys here in the coming weeks, and it's just going to continue really heavily focusing on that, because that's my passion. I want to pour into consumer education and just educating, any of my realtor partners or just real estate agents, anyone in the industry out there. And it helps me learn more as well. So as I grow, you'll grow with me, and we'll be able to educate as many people as possible on doing real estate right. So hope you have a wonderful day, and hope you enjoy this market update, and I look forward to touching base next week.